Okay, students, when we look at Chapter 9 here, we're going to talk all about liabilities. We need to understand what liabilities are, first of all. Most people know it as something that you owe, and so clearly that is a working definition, but a formal definition would be probable future payment of assets or services that you're obligated to pay. All right, we're going to look at current liabilities first. We need to understand the difference here to long-term liabilities. Long-term liabilities like a mortgage or a car loan, something like that, you're going to pay over years and years. Those are important, of course, but current liabilities are very important to a company because they always want to look at what's due within the accounting period. Okay, so even on a long-term loan, they'll break out a chunk of that loan and call them current liability. If you had a $500,000 loan on a property or something like that, you would break out the chunk of that that was due within a year or less, or one accounting period or sooner. So usually 1 year or less, and that's called current liabilities. These typically come from receiving goods or services before paying. Could also come from receiving payment before you delivered goods and services. For instance, if you got money in advance for a job you were going to do for a customer, or if somebody paid in advance and you haven't delivered the goods yet, if something was on back order. These are all unearned revenues if you're the one receiving the payment. Okay, so there's lots of ways that current liabilities come about. These are two of the main ways that that happens. Let's look at some common ones, right? Okay, company actually has a liability if they are a retailer, and if they collect money from you up front, they are the ones who have to pay the sales tax to the state or to the feds or to local municipalities. So if you buy a $100 item here and you get $100 of sales, you actually will pay to the retailer $107.25. So what this means is that the retailer, and these are his books, not yours, they have collected $107.25 in cash. They only recognize $100 of sales revenue, and they have $7.25 of sales tax payable. That's a liability that they must pay to the government. And some companies actually, you can go look it up, they get in trouble for not paying their sales taxes. They want to keep that money, I guess, and break the law, but they do get caught in almost every case. Okay, a lot of companies do business under the table specifically to avoid paying this sales tax to the government. Okay, but this is what happens unbeknownst to the customer. But anyway, it is a true liability for the retailer. This is a very common liability, and even though it has the word revenue in it, this is unearned revenue. If somebody pays in advance, then we want to make sure we understand that it's not a revenue account. It is a liability account. It goes up with a credit just like revenues do, but it is not a revenue account. Suppose you hired a contractor to do $1,000 worth of work at your house. You may have paid him cash. So these are his books, not yours. He takes in $1,000 cash, so you debit cash, and he now has a liability called unearned revenue for $1,000 until he does the job. If he does half the job and the end of the accounting period happens, he would recognize only half of that revenue. He would take it out of unearned revenue, call it revenue, and he would only recognize half of the revenue if he did half the job. Okay. Short-term notes payable. Okay, if you have an account payable that you can't pay, sometimes people will give you, or the lender will give you an account payable. I'm sorry, a note payable instead of an account payable because it bears interest. Let's suppose that somebody converted an account payable into a note payable. It's $1,000 of accounts payable. This used to be a liability. Well, it is liability. You're paying it down by converting it to a note payable. And so the only way to do that here was by converting it to a $1,000 6% interest-bearing note to be paid in 3 months or 90 days. If you remember, principal times interest times time is how you calculate the interest. So if I took $1,000 times 6%, that would be $60 total, right? 1% is $10, 6% would be $60, but that's $60 if it were a whole year. 90 days is 1/4 of a year. If you just divided 90 by 360, we're using a banker's year, 360 days. You'd get 1/4 of that. 1/4 of $60 of interest would be $15 of interest. So 3 months later, on April 1st, okay, you would pay down the note payable. You would have an interest expense of $15, and the total cost out of cash for you would be $1,015. So here are some examples of payables or current liabilities. Typically, a payable is obviously a liability, but don't forget unearned revenue is also one. Okay, some common liabilities. Those are covered in your book as well. All right. A different type of liability, this is covered I think in the end of chapter 9, is a contingent liability. You will take on a liability if there is some unpredictable things that will happen, and so you have to estimate them. Very similar as a mechanism for accounting. It's very similar in how it works to accounts, allowance for doubtful accounts. You don't know how many people are going to fail to pay you, so you have to estimate the unpayable accounts. Well, if you're selling, let's say, cars or washers and dryers, whatever you're selling, there's a warranty cost in many cases. You don't know exactly how many of those devices are going to go bad and how many people are actually going to turn in their car or their washer or their appliance, whatever it is, for a warranty. So you have to estimate them. Hopefully the company has some historical data, and you'd see an automaker averages 4% warranty costs on a $30,000 car. Here's what they would do. Okay, you would take 4% times 30,000. All right, and you would say, all right, let's, for this specific car, okay, let's just accumulate 4% times 30,000. That would give me $1,200. That'd be an estimate for every car that we sold. Okay, so we would take this journal entry, but of course not every car is going to come in for a warranty. That's just an estimate we make. All right. Now all of a sudden we have this payable. We have this liability account here that's called warranty payable, and so we have this cushion, if you will, or this liability in case the cars do come back for warranty. All right. So we've recognized the expense here during the same period in which the car was purchased. That is in accordance with GAAP. It's in accordance with the matching principle. Any expenses must match the period in which you enjoyed the privilege of the sale. And so that works. All right. So I think your book may call it estimated warranty expense. Okay. But warranty payable is another way of looking at that. Okay. I think your book calls it an estimated warranty liability. But clearly when the word liability comes in here, you will see that it is a liability. All right. So what happens if the car does come back? If one car comes back and doesn't cost $1,200, then we have $200. And what typically happens is that is paid out of parts inventory. All right. Now to fix a car isn't free. There's some labor costs involved there, but the dealer usually has to get reimbursed from the corporate office, the national office, or they just eat the cost of the labor. This is why they don't want to do warranty repairs. They'd much rather just actually spend the labor costs on fixing cars, and they can charge revenue for a repair that you have to pay for. If this is covered under warranty, the labor costs are not part of this. They typically will pay for the parts. They have to eat the cost of the labor, because when you go take your part in for service, whether it's a car or a washer, dryer, the company actually pays for that, not you, but they have to eat that cost. Okay, so it's an internal labor expense that they don't get to journalize. Okay, that's about it for now. I think we'll get into payroll taxes in a few moments, so we'll move on.